On April 7th, President Trump took to Truth Social to deliver his ultimatum. If China does not withdraw its 34% increase above their already long-term trading abuses by tomorrow, the United States will impose additional tariffs on China of 50% effective April 9th. This one line from President Trump was enough to set off a global financial earthquake. Just last week, we saw markets reel as implementation of Trump's tariffs sparked a 7.6% crash in Shanghai, a 13.7% plunge in Hong Kong, historic point losses on the Dow, 2,231 points, 5.5%, and a 6% drop on the S&P unurade. Despite the market chaos and international backlash, President Donald Trump confirmed on April 9th that the United States is officially imposing a 104% tariff on Chinese goods. Speaking through the White House, Press Secretary Caroline Leavitt declared that Trump would not yield, asserting, "America will not break under his leadership." The move marks a dramatic escalation in the trade war with China, which quickly denounced the action as blackmail and vowed to fight to the end. In addition to the blow to U.S.-China relations, the Trump administration also announced sweeping tariffs on dozens of other countries, including a 20% levy on European Union goods, 26% on Indian imports, and a sharp 49% on Cambodian goods, effectively opening a new front in a global trade war. In response to the U.S. measures, China announced a retaliatory 84% tariff on U.S. goods on April 9th. What does it mean for you, your investments, and the world economy? Keep watching to get all the answers. Trump announced what he termed Liberation Day tariffs, a striking policy initiative that imposed a baseline tariff of 10% on all imports on April 2nd. What truly caught markets off guard was the escalation in tariff rates for key trade partners. For instance, China was subjected to an extra 34% tariff, which, combined with existing duties, resulted in a total tariff rate of 54% on Chinese imports, effective April 9th. In retaliation, China announced a 34% tariff on U.S. goods, set to take effect on April 10th. All this resulted in significant market downturns, heightened recession fears, and strained international relations across the globe. First, let's take a look at the events that unfolded in the USA following President Trump's announcement of sweeping tariffs. The announcement triggered immediate panic among investors. The Dow Jones Industrial Average, DJIA, plummeted by approximately 1,600 points, marking one of its most significant single-day drops since the 2020 pandemic-induced crash. Both S&P 500 and NASDAQ experienced substantial losses, with the S&P 500 dropping around 4.8% and the NASDAQ composite falling by nearly 6%. The following day, China responded by announcing retaliatory tariffs, which intensified fears of a full-blown trade war. The DJIA fell by another 2,200 points, bringing the two-day total loss to over 3,800 points. The S&P 500 and NASDAQ also continued their downward trajectories, each losing an additional 5 to 6%. The rapid decline led to a surge in market volatility, with the CBOE Volatility Index, VIX, often referred to as the fear gauge, reaching levels not seen since the early days of the COVID-19 pandemic. Over the weekend, the administration faced mounting criticism from both domestic and international leaders. Concerns grew about the tariffs' potential to stoke inflation and hinder economic growth. Despite this, President Trump remained steadfast, asserting that the tariffs were necessary to correct long-standing trade imbalances. In response to the escalating crisis, the Federal Reserve signaled potential interventions to stabilize the economy. Discussions of possible interest rate adjustments were floated to mitigate the adverse effects of the tariffs. However, market sentiment remained cautious, with investors wary of further policy unpredictability. Since the financial landscapes of the United States and China are deeply intertwined, we saw a dramatic downturn in China's stock markets. Analysts and investors speculated on the potential economic fallout, with concerns mounting over disrupted supply chains and increased costs for consumers and businesses alike. On April 3rd, the Shanghai Composite Index fell by 7.6%, while the Hang Seng Index in Hong Kong dropped by 13.7%. These declines reflected investor concerns over the potential economic impact of the tariffs. When Chinese financial markets opened after the weekend, it experienced significant turmoil in response to escalating trade tensions between the United States and China. The Shanghai Composite Index plummeted over 7%, marking its worst single-day performance in 5 years. Similarly, Hong Kong's Hang Seng Index suffered a steep decline of 13.2%, the most substantial drop since the 1997 Asian financial crisis. Investors reacted swiftly, leading to widespread sell-offs across various sectors. Notably, the Hang Seng Tech Index plunged 17%, reflecting concerns over the impact on technology companies heavily involved in international trade. In an effort to stabilize the markets, China's sovereign wealth fund, Central Huijin Investment, intervened by increasing its holdings of Chinese stocks through exchange-traded funds. This move aimed to bolster investor confidence and mitigate further declines. The market's reaction underscored the vulnerability of Chinese equities to international trade policies and highlighted the broader economic implications of the escalating tariff dispute between the world's two largest economies. Global financial markets experienced significant volatility due to escalating trade tensions between the United States and China. The imposition of steep tariffs by the US, including a 104% duty on Chinese goods, has disrupted international trade flows. Major stock indices worldwide have experienced sharp declines. Countries like Vietnam, Thailand, and Cambodia, which had become alternative manufacturing hubs due to rising Chinese labor costs, are now facing tariffs ranging from 24% to 49%, further complicating global supply chains and prompting companies to reassess their production strategies. Beyond financial markets, the trade war has raised concerns about a potential global economic slowdown. Economists warn that continued escalation could lead to a recession, with projections of up to 2 million job losses and a significant decrease in household incomes in the US. Furthermore, industries heavily reliant on international trade, such as technology and agriculture, are experiencing disruptions, with companies facing increased costs and supply chain uncertainties. The ripple effects extend to emerging markets, where countries like Bangladesh and South Korea are grappling with new tariffs on their exports, leading to economic strain and prompting governments to seek emergency funding packages to support affected industries. Singapore's Prime Minister, Lawrence Wong, has issued a stark warning regarding the escalating global trade tensions instigated by US President Donald Trump's recent tariff announcements, labeling this phase as arbitrary, protectionist, and dangerous. Wong highlighted the potential for a full-blown global trade war, emphasizing the resulting uncertainty in the global economy. Despite Singapore's heavy reliance on trade, the nation has opted not to impose retaliatory tariffs, even as it finds itself subjected to a 10% levy under the new US policies. Drawing a historical parallel, Wong compared the current trade disputes to the prelude of World War II, where economic conflicts escalated into armed confrontations driven by opposing ideologies. He urged global citizens to remain vigilant and clear-eyed about the dangers that are building up in the world, underscoring the unpredictable nature of the current economic landscape. Wong asserted that these developments signify a seismic change in the global order, marking the end of rules-based globalization and free trade. In response, the Singaporean administration is preparing additional support measures and advising its citizens to brace for rough waters ahead. All things considered, the trade war is more than just a battle over tariffs. It's a signal of a deeper shift. For decades, the world ran on the idea that countries should specialize, trade freely, and benefit from each other's strengths. That system is now cracking. If this trade conflict keeps growing, we could see a more fractured world economy, less cooperation, more tariffs, and countries pulling supply chains back home or to closer allies. But amid the uncertainty lies a chance to build a more resilient, balanced, and locally empowered global economy, one that learns from the past to create smarter, stronger connections for the future.